Hi everyone. So welcome to the live stream today. It's always a pleasure coming your way as we continue with our discussion in the IFRS Masterclass towards the ICA November 2021 examination. And I see some of you guys coming up. When you join the stream, give us a thumbs up on the video. Remember to subscribe to the channel and most importantly, share the video. Let us reach as many students as possible. In case you missed the part 1 and the part 2 of the IFRS Masterclass focusing on IFRS 16 leases, where we discuss the various issues that we need to understand and then what the treatment when payments are made in advance. The part 1 and part 2, in case you missed that, it is in the description to this video. You can watch that and then follow up with this particular video as we continue with our discussion. This is the final part, the part 3 of my discussion with you on IFRS 16 leases, and today we want to look at how the accounting treatment is going to be like if we are making payments at the end of the year or in arrears, and also when we are making the payment half yearly, how the treatment is going to be like. And that is what we want to focus on today and see what we can do. And I'm going to share my screen with you real quick right now as we continue with it. Now, remember that if you have any questions, you know what to do. You put it in the comment section or you put it in the chat box. I'm going to read all your comments and also share my thought on them as we continue with our discussion here and help you to understand what you are doing much better. Remember, this is the final part, the part 3. In case you missed the 1 and 2, you can check it up in the description to this video as we continue with our discussion. So let's go straight up into our discussion. Yesterday, we concluded on this part of it. We solved a question where payments are made in advance, and we saw how the treatment is supposed to be done and how the financial statements are going to be treated. So I want to go straight up into the second question that we want to look at when payments are made in arrears. So when payments are made in arrears or at the end of the year, how do we go about it and how do we represent that in the financial statement? That is what we want to look at today and start with today. So let's go. Question 2. So you can actually take a screenshot of the question so you can follow up with me. It's on the screen. I'm going to be going through with you, but you can follow up with me as well on the screen as we continue with the discussion. So let's go. Question 2, lease payment in arrears. Just a quick recap. You remember that we said when it comes to the lease payment at the end of the year, we're going to be still preparing the schedule for 2 periods, usually because we want to split the carrying amount of the lease between current and non-current components in that case. So you're going to see how that is going to actually play out and be presented in the financial statements for the company. So Michelle Limited prepares financial statement for the year ended 31st October each year. On 1st November 2018, Michelle Limited leased a property on a 10-year lease payment with Doris Property. The annual lease payments were $2.5 million payable in advance. The first payment being made, this should be payable in arrears. That's an error there, as we were just looking at the same question contextualized. In arrears, the first payment being made on 31st October 2019. So if you check the dates carefully, you realize that this time around, payments are made at the end of the year for the company because the year ended is 31st October, and that is exactly when the entity is going to be making its initial payment or its first payment. Then we are told that Michelle Limited incurred an initial direct cost of $0.5 million in arranging this lease and received an incentive of $0.25 million. Annual rate of interest is 10%, but be careful here. We are told that the present value of $1 payable at the end of years 1 to 10 is 6.145 Ghana cedis. So you realize that now in the question we solved yesterday, the first question, you realize that we were not given the annuity factor, so we had to calculate it ourselves because it wasn't given in the question. But in this second question, the annuity factor has been given to us as 6.145. 145. So this annuity factor which has been given to us is what we are going to be using in that case. But even if you use the formula and do the calculation or do the computation, you realize that you will get 6.145. But we are not going to be going through that today because it is given to us directly in the question, and we're just going to look at that and go away. So let's go to our slide real quick. So question 2. We are still in the books of Michelle Limited. Now, so what's going to happen here is that we are going to be looking at the initial recognition. Now, when we look at the initial recognition here, we need to look at the lease liability. Now, unlike in advance, in the question we solved yesterday, where the payments are made in advance, hence we were looking at 9 years to calculate the annuity factor. In this question, because the payments are made in arrears, the lease outstanding is still going to be 10 years. Okay, the lease outstanding is still going to be 10 years. So assuming we're calculating our annuity factor, okay, that is the 1 minus 1 plus r exponent negative n over r. Assuming we're doing the calculation, in this case, we won't do it though, but the n will still be 10 here. Why? Because payments are made at the end of the year. Unlike yesterday where we used 9, this time around we will be using 10 to calculate the annuity factor. So to get a lease liability, we are saying that that is going to be the annual lease payment multiplied by the annuity factor. Annual lease payment multiplied by the annuity factor. So in the question, our annual lease payment is still 2,500,000. We bring in our annual lease factor to be 6.145. Remember, that will be the annuity factor still. If we were looking at calculating the annuity factor ourselves, we would have come to that particular figure as well. So we multiply up. Let me grab my Casio calculator real quick. So 2,500,000 times 6.145. Boom. I'm getting 15 million. 362,500. 15,362,500. So this is the lease liability. So the double entry for this lease liability, like I said, you are not supposed to do this in the exam or like showing the double entry like that. It's good to debit the right of use assets and then you credit lease liability. That is the double entry. So our lease liability is going to be 15,362,500. Then we recognize the right of use assets. Remember, I told you that we need to number, so that is workings 1. And this is workings 2. So right of use assets. The reason why we are numbering is for professional presentation. We don't want to screw it up for ourselves. So we bring in the lease liability. And that's going to be coming from workings 1. And that's 15,362,500. Then we go back to the question to pick the rest of the items that we have in the question. We are told that there is an initial cost of 0.5 million. So we bring it in. Initial direct cost. 500,000. Then there was an incentive, we got 250,000, so that is going to be less. So we take it out, and that becomes the initial cost of the right of use. So let's add it up. Plus 500,000 minus 250, 1, 2, 3. So I'm getting 15 million 612,500. 15,612,500. So that is going to be our initial recognition. Remember, in this question, we did not calculate any annuity factor, unlike the first question we solved. Why didn't we do any calculation? Because the factor was already given to us in the question as 6.145. So if it is given directly in the question, which would usually be the case, you just take it there and then you get your answer in that case. Then we go to subsequent measurements. So on subsequent measurement, you know already that we will depreciate the assets. So workings 3, right of use asset. So we bring in the initial cost coming from workings 2, and that was 15 million 612 500. Is that what we had? Yeah. Then we bring the depreciation for the year ended 31st October 2019. Remember, in the question, I didn't even go through the requirements. We are preparing for, because it's the same thing as yesterday, 31st October 2019, and then for 2020. So 31st October 2019, 31st October 2020. So for 31st October 2019, remember this is on a straight line method. So 15,612, 500 divided by 10 years. Why? Because in this question, the lease term is 10 years. We are not giving the economic useful life of the asset. Assuming the economic useful life of the asset is given, then we will choose the earlier of the two as the number of years to be used to depreciate the asset for the entity in that case. So if we check that up divided by 10, I'm getting 1 million 561,250. So you take it out so that we get a carrying amount as at 31st October 2019. Okay. So minus 15,612,500. I'm getting 14 million and 51,250. So you can confirm that as well. Then we come to the depreciation for the year ended 31st October 2020. And since it's on a straight line method, it means the same amount of depreciation is going to apply here. So we're going to have 1561,250. We take it out. Then we get a carrying amount as of 31st October 2020. And that is going to be 12,490,000 dollars. $12,490,000. You can cross-check that and see if that is the answer we are actually having in that case, to see whether that is the answer we are actually having in that case. So that is the third workings dealing with the right of use of assets, the right of use of assets. Remember, the depreciation will go to the P&L account. The depreciation will go to the P&L account. Then the carrying amount to go to the statement of financial position. Okay, and we're going to be doing that. Remember, this is not what the examiner said we should do. The examiner didn't ask you to do this. The examiner said, how will this be presented in the financial statement? How will this be presented in the financial statement? That is what the examiner is asking us to do. So let's see what we got. Let's see what we got. So we go to workings 4. That will be the lease liability being carried at amortized cost. So the lease obligation, we preparing the amortized cost schedule. So we bring the year ended up. Let's rule our line. Bring the balance brought forward. Let's make that a bit bigger. We bring our, now remember here, payments are made at the end of the year, right? Hence, we will charge interest first. And then we will get the lease payment. Then we will get the balance brought down. So there we go with this one. There we go with this one. So let's put it up. Let's bring in our currency signs. So we're going to be doing for probably 3 years. Because we are doing for 2020 and 2021, sorry, 2019 and 2020. I'm going to explain that in a moment. So 2019, the balance brought forward of the lease liability from the initial recognition is this: 15,362,500. 15,362,500. Remember, the interest rate implicit in the lease is 10%. Our annual lease payment is 2,500,000. So 10% of this that's going to be 1,536,250. So you add the interest to the opening balance and then subtract the lease liability, and that gives us the closing balance. So 3,625,500 plus 1,536,250 minus 2,500,123. So I'm getting 14,398,750. 14,398,750. Now, remember I told you that if we are making payments in advance, in arrears, that is at the end of the year, we will do the workings for 2 periods, so that the second period will become the non-current liability, and the difference between the first and the second becomes the current liability. You remember that? You remember that? So we will do 2020. So when it comes to 2020, this closing balance becomes an opening balance here, 14 million 398 750. Remember, our lease payment is still 2,500,000. Let's get 10% of that. And that's going to be 14,398,75. So we get the arithmetic coming up. 14,398,750 minus 2,500,000, 1, 2, 3. And I'm getting 13,338,625. And you can confirm that as well. So assuming we are preparing the financial statement from the for the year ended 2019, this 2020 figure would have become the non-current liability. Then the balancing figure between the 2019 and 2020 will become the current liability. And I'm going to deal with that. But in the question, the examiner said we should do for 2019 and then 2020. For that reason, we will add another year to it. $2021. Okay, so we are supposed to do for 2019 and 2020. But because payments are made at the end of the year, we are going to be adding another year to it. So let's bring the opening balance, 13,338,625. Let's get 10% of that. That's 13,386,2.5. We can work to the nearest. So 62.3. Let me write that again. 133,3863. Like this. Still, we are paying 2,500,000 coming up. Then we add that up. So 13,338,625 plus 13,338,63 minus 2,500,000, 1, 2, 3. I'm getting 12,170,172,488. 12,172,488. So remember, this interest goes to the P&L account. Okay, we'll go to the profit or loss account. Remember, the lease payment never goes to the profit or loss account. The lease payment never goes in the profit or loss account. Then, like I said, we are going to be extracting the financial statement. So all these are the workings we do to arrive at our answers in that case. So that is the amortized cost schedule. Now let's extract the financial statement and find out exactly what is going on here. So we bring the name of our company up. So Michelle Limited. So we're going to have statement of profit or loss. Remember, this is an extract for the year ended 31st October 2019 and 2020. We're going to present that in a columnar form. So we'll have 2019 here, have 2020 coming in here, slashing our dollar sign. We're going to have depreciation coming in. I guess that is from working straight. So let's go to working straight to pick up the depreciation on the right of use. And that is going to be the issue in relation to 1,561,250. 1,561,250. And that's on a straight line method. So the same thing will come here as we computed here. Then we come to the finance cost. That is going to be in workings 4. So that's in workings 4. And we're going to have 1,536,250. 1,536,250. Then for 2020, it's going to be 1,439,875. 1,439,875. So this is our income statement. Now remember, it's an extract. These are all expenses. So we could actually leave it like this and not do anything to it. There is no need for you to add it up, or better still, we could put it in brackets. Okay, we could put it in brackets. Remember, this is an extract, so we could as well just leave it like that. Nothing will happen to it. It's an extract. These are all expenses, or we could put them in brackets. That is also allowable. Then let's look at the statement of financial position, which is where the real deal is for our work. So statement of financial position. So when it comes to dealing with the statement of financial position, what do we do? How do we go about it? Again, we're going to be presenting that in a columnar form. Maybe let me put it down well. Statement of financial position. This is an extract. Again, as at 31st October 2019 and then 2020. So we present again in a columnar form. 2019, 2020. We're slashing our currency sign. So in the statement of financial position, among other things, we're going to be having non-current assets. Under that, we will have the right of use assets. And that is going to be coming from workings 3, the carrying amount. So we go to workings 3 here. This is workings 3. Carrying amount for 2019, we can see that it is 14,051,250. 14,051,250. Then for 2020, we're going to have 12,490,000. 12,490,000. So that is the non-current asset. Again, this is not a big deal. This is not a huge area that we are going to be really worried about. Now let's go to the liabilities, and that is where it will be very interesting. So liability. And when it comes to liability, we will have non-current liability. Under that, we will have lease obligation from workings 4. Don't worry, I'm going to be dealing with that. Then we will have current liability. And again, there we will have lease obligation. And that's going to take the balancing figure. And I'm going to explain that to you in a moment. So if you check for 2019, we're going to be bringing the total figure here. The total figures up. Stay with me carefully here so you get this. So in the workings 4, 2019, the carrying amount is this figure, 14,398,750. 14,398,750. That's the total. Now we're going to be splitting that between the current and the non-current. When it comes to payment in arrears, payment at the end of the year, what we do is that the second period, this one becomes, the next period, okay, becomes the non-current liability. So that is 13,338,625. 13,338,625. That becomes the non-current, so that the balancing figure becomes the current liability. Does it make sense? The balancing figure. So let's see what we get. 14,398,750 minus 13,338,625. So I get 1,601,125. That is the split. That is the split in that case. And if you miss this particular split, that's where it becomes difficult. Look at it again for 2020. In 2020, our liability is 13. So we bring it up. 13,338,625. That's our liability total. So we split that into current and non-current. How do we do the split? Simple. The next period, 2021 figure, becomes the non-current liability. That is 12,172,488. 12,172,488 becomes the non-current liability. Then the balancing figure is the current liability. So let's see what we got. 13,338,625 minus 12,172,488. And that's going to give me 1,166,137. So this is how we present the financial statement for the lease arrangement when payments are made at the end of the year or in arrears. When payments are made at the end of the year or in arrears. Any questions, please? Any questions, please? I see some of you guys joining. You are welcome. Give us a thumbs up on the video if you are getting some value in here, and share the video as well. Let us reach a lot of people. If you are watching and you have any questions, put it in the comment section, put it in the chat. I'm going to be answering all of your questions, and I see some comments coming in. Let me look at these comments and then answer them real quick as we continue with our discussion. Vincent Boster said, Vincent Boster watching from Arusha, Tanzania. Okay, Vincent, I hope you're doing well. Peter Makasa said, watching from Zambia. Okay, you are welcome, Peter Makasa. Edison said hello, following from Dar es Salaam, Tanzania. Okay, nice presentation, sir. Thank you, Edison. Then we see Uchuno Sharon. I don't know if I mentioned your name right. Forgive me if I don't mention your name right. Okay, Uchuno Sharon. I see you with an emoji thumbs up in the chat. Thank you very much. Mabel Lani said, "Good evening, Nhyira. Good evening, Mabel Lani. I hope that you're doing well. Welcome to the live stream, and thank you for joining us." I see Scarlett Chitalu. Scarlett, you are welcome. I think you joined yesterday as well. Mabel Lani, Godfred Kisi, Ampofo, Bridget Enam, Nuhoho, Bridget Enam, Nuhoho, and then Chumesi Eric. Thanks very much. You guys have given us a thumbs up on YouTube, and we really appreciate that. Godfred Lumbala said, "Here is Godfred Njamba watching from Zambia." Okay, thank you for joining us. Scarlett said, "Hi Nhyira, Zambia here." Okay, we have a lot of Zambians coming in today. Thank you very much for joining us. It's always a pleasure. Remember to share the video as well in with your colleagues. We want to really reach a lot of students across the continent, so share it in your various countries as well. Let us get a lot of people getting access to these contents that we do on the channel, so it helps you to become more successful. Godfred Kisi Ampofo said, "You are doing well." Thank you, Godfred. Thank you very much for joining us on the live stream. So that is how we deal with the treatment when we are having payment at the end of the year or in advance. Sorry, in arrears. So now we've looked at leases when payments are made in advance. We've looked at the leases when payments are made in arrears. Now let's look at leases when the payments are made within the year. Are you getting the idea? So it is plated and made half yearly. How do we go about it, and how do we present that in the financial statement? That is the third thing we want to look at. If you have any questions, put it in the chat. I'm going to read all of your comments and bring them on board. In that case, Sebokazi Indila. Forgive me if I don't mention your name right, okay? Because I'm trying to see if I can mention them well. Sebokazi Indila said, "Watching from South Africa." Okay, that is nice. Sebokazi Indila. Chino Shaw said, "Good evening, sir." Good evening, Chino. I hope that you are doing well, and thank you for joining us. Chino said from Sierra Leone, yeah. Thank you very much, Chino, for joining us. So let's get back into the discussion, and then let's look at our final question. Remember, I told you that when it comes to dealing with leases, three things will be happening. Either we are making the payment in advance, whether we are making the payment in arrears, or whether we are making the payment half yearly. So we want to find out how exactly we go through that in that case. Now, this half yearly lease treatment is actually an extract from the ICA single entity question, I think November 2020, the single entity question, footnote 3. So I picked this transaction from the footnote. So it is not a question that was standing on its own. It is part of the footnote, and I picked it up to illustrate the idea because it is just on its own, and it can help us to illustrate the idea for the treatment. So let's look at it. On 1st January 2019, Marco Limited entered into a lease agreement to lease several machines. The lease was for a 4-year period, which was estimated with an estimated useful life of the machine, which was the estimated useful economic life of the machine. How am I messing that up? Which was the estimated useful economic life of the machine. Yeah. Marco Limited is required to repair and ensure the plants I think it should be insure, not ensure, and insure the plant, which has no residual value at the end of the lease. The lease rentals were at 10 million every 6 months. Be careful here. 10 million every 6 months, payable in advance. Payable in advance. What it means is that on that January, we're going to be making the payments that is going to be covering the period for that, and then we're going to be presenting it in that case. Then we see lease rentals figure is 20 million in respect of the lease. The rate implicit in the lease is 5% per 6 monthly period, and the present value of the minimum lease payment is 60 million as at 1st January 2019. As at 1st January 2019. So let's see what exactly is going on here with this particular question. Now remember, you have to be careful about the interest rate. In this case, the examiner said 5% per 6 monthly period. Assuming it had just stated as 5%, that would have been taken as 5% per annum, in which case we would have divided it into 2 and would have arrived at the interest rate for every 6 months. Now, the idea here is very simple. The year ended of the company is given to us to be 31st December. Like I said, this was an extract from the question was 31st December 2019. So how do we present this in that case? We go straight up and then look at how we will present this in the financial statement for the entity. My focus here will be on the lease liability, the subsequent measurement. So let's look at the lease obligation. So we're going to put our schedule up. So we're going to bring our period ended. We're going to be bringing in the opening balance. We're going to be bringing in any lease payments. Because they are made in advance, we have to make the payments before charging any interest. We get a capital balance coming in, or the outstanding balance if you want to. We get an interest. I don't think I did my pagination well. Let me do that again, because I don't want to squeeze things up. So lease payment, that's not going to be too big. Capital balance or the outstanding balance. We're going to have the interest coming in. Then we have the closing balance. So we like to tell the examiner that, yeah, even though we see the figures 20 million, we like to tell the examiner that, hey, we like to work in 3 zeros up in that case. Now, stay with me carefully here. You will know that the interest rate implicit is 5%. We're going to be bringing that up. So now 6 monthly 6 monthly. That is very, very critical. So if it is 6 monthly, I mean, how do we present that? How do we go about it? So the lease started on 1st January. So from 1st January 2019, 6 months is on where? 30th June 2019. So we'll prepare the schedule for each 6 months in that case. Now, I want you to stay with me carefully here. So 30th June 2019. 30th June 2019. Now, what is our opening balance? We are told that the lease, present value of the minimum lease payment at 1st January is 60 million. So that's going to be 60,000. You bring it up. Now, for the period ended to 30th June, we have made our initial payment coming in already. We made initial payments of the lease payment is 20 million, and we are told that the lease liability as at 30th June is going to be 60 million. So that is going to be coming up there. That is what we've brought. Now, for the period for 30th June, we're not going to be making any payments in that. Hence, the capital balance is still going to be 60,000. Then we apply the 5% on that. And that is going to be 3,000. So the carrying amount is going to be 63,000. Then we come to 31st December 2019. We bring that 63,000 up. Now for the 31st December, we're going to be making the payments for the next period. So that is going to be 10,000. We deduct it, and that gives us the 53,000. So we calculate our 5% interest on the 53,000. That's going to be 2650. So 2650 plus 53,000. That's going to be 55,650. 55,650. 55,650. Then you come to 30th June 2020. So we will do for another period like that, just to be able to help us to split between current and non-current in that case. So 55,650, we less the 10,000 coming in, we get 45,650. You apply 5% on that. We get 2283 approximately. So 2283 plus 45650, and that's going to be 47933. Now, when it comes to dealing with issues about payment in the middle of the year, normally issues come up with how we split the amount between current and non-current. Now, so you realize that when it comes to this place, the interest expense or finance cost is going to be the 2 6 months figures, the 3,000 here, the 2650 here, and that's going to be 5,650. That's going to be the interest expense. Now, when it comes to arriving at the lease liability, current and non-current, because this is an extra, that's why I'm presenting like this. In that case, what is going to be happening here is that we are going to say that this ending figure 55650 is what we are going to be splitting between current and non-current. So what we will do here is that the lease liability, which is the 55650, must be splitted into current and non-current. So how do we get a current component? How do we get a non-current component? So the way we get a current component is to simply ask ourselves this. Now, if you look at it, for the next period under consideration, that is in the year 2020, we're going to be making payments for, as of June 2020, as of June 2020, and then as of 31st December, I didn't do that because we don't really need that, also 2020. So we're going to be paying 20,000 on that. Now that finance cost there is 2283. So what is going to be happening here is that the current component is going to be the lease payment for the next 1 year minus that immediate 6 months finance cost, which is 2283. So our current component becomes 20,000 minus 2283, and that's 17,717. So that our balancing figure, remember our lease liability as at 31st December is 55,650. So the balancing figure from that becomes the non-current component. That's 37,933. 37,933. So that is how we deal with the current and the non-current. Now, let me also say this. There is another school of thought that also states the split to be that you calculate for all the interest payable in the remaining period of the lease, and then you deduct it from the carrying amount. So all the lease, all the interest outstanding for the remaining period will become the current component. Then the balancing figure of that becomes the non-current component. But we're going to be just staying with this one. So the next period, the next 6 months lease payment minus the next 6 months interest expenses is the current liability. Then the balancing figure is the non-current liability in that case. So that is the idea about that. So like I said, this is an extract coming in for the period under consideration. For the period under consideration. Okay, so let's see if we have some questions coming in. Godfred said, you really do a great job by coming through this platform. This really facilitates most of the people's academic journey. A big thumbs up for you. Thank you very much, Godfrey, and I'm calling you Godfred. Sorry about that. Kledos. Oh, Kledos. I hope that you're doing well. You are Always the best. God bless you and keep you safe. Amen. And God bless you too, Cletus. Then we have Godfred. Okay, so there is Godfred and then Godfrey. Okay. Can you explain why there were no payments for first 6 months? Okay, so let's take back the slide in that case. So we see that in the question we are told that the lease is set for every 6 months payable like that. And then as of January, we are going to be, well, let me take a cursor, then clean this up. As of January 2019, we have the present value of the future lease payment estimated to be 90 million in that case. So if it is estimated to be, to be 60 million in that case. So if it is estimated to be 60 million, it means that we are going to be making our 6 months payments not on that date that we are making the payment, not on that day, but then the payment is going to be coming in 6 months after that date, which is on the 30th June. That is why for that period coming in, we are not going to be making any payment. Hence, for that 6 months period, the interest will be charged on the 60 million. So our first payment will be done on 30th June. Our second payment will be done on 31st December, 30th June, 31st December, 30th June, 31st December, in that order. In that order. So that is how, or that is why that 30th June, we are not having any amount in there, because we are going to be making the payment on 30th June for the period under consideration. Godfrey, let me know if it makes sense for you. Montadi said, can you come again on the split? Okay, so we said that when it comes to the split, the next 1 year, every 6 months, we're going to pay 10,000. So the next 1 year will be 20,000 lease payments. Then we will subtract the next 6 months interest from the lease payments for the 1 year. That figure is what gives us the current liability. Then that's current liability from the amount at 31st December, which is the balancing figure, gives us the non-current liability. Gives us the non-current liability. Gives us the non-current liability. So that is the idea there about the split. So Muntadi, let me know if that makes sense for you. So that is the idea about that. So we've looked at when lease payments are made in advance, when lease payments are made in arrears, and then when lease payments are made in the middle of the year. And one thing you need to understand is that now this is at the financial reporting level. There are other aspects of leases that we need to look out for, we need to know about, and that is the concept of sale and lease back. So if an entity sells an asset and leases back the asset, how do we account for that? And then how do we deal with the whole thing? Now, time will not permit me to go into sale and lease back in that case, but we will make a content available on that because I don't want to really spend a lot of time just on this standard. But there is sale or lease back also there. I'm going to explain the concept for you, but not necessarily solving any questions with you in that case. I'm going to explain the concept for you so that you understand how the treatment is actually done as we move ahead with the discussion. Let me open my slide on that and see if I can share that with you on my screen. Okay, yes. So I have that here. Let me bring it up on my screen on the iPad so that I can share my screen with you on that. Okay, so let's touch on the concept of sale and lease back. Uh, Let me airdrop. Let's see. Okay. Ooh. Okay. Come on my iPad now. So let me explain the concept real quick. Sale and lease back. Hey, I'm not sharing my screen. Now, the concept about sale and lease back, it's simply about the fact that, companies want to raise money to be profitable as an organization. I mean, they want to raise money and be profitable. But there are times when they cannot raise money from anywhere. Instead, they would have to sell their assets. But then they also need the assets for the day-to-day running of the organization. So how do we go about it? And how do we actually put these pieces together? I mean, how do we go about it? And how do we put the pieces actually together? The way we go about this whole thing in the context of looking at sale or lease back is that the entity has the asset. So we can have our entity A here and we have an entity B here. So we can say that the entity A is the one who possesses the asset, who is the owner of the asset. They need money. So they will sell the assets to entity B. We'll call them buyers or finance providers. Now, follow me carefully here. This is where the relationship between IFRS 15 and IFRS 16 comes to town. So follow me. Let me explain the concept real quick here. Now, so the owner of the asset is there. They need money, so they try to sell the asset. But they will arrange with the buyer that, hey, even though we are selling this asset to you, we want to lease it back. We want to lease it back in that case. However, what happens is that if performance obligation is not satisfied, as per IFRS 15, then the transaction is not a sale, but instead a financial arrangement. Let me take that again. What do I mean by that? In other words, if there is no transfer of ownership from the seller to the buyer, that means the thing is actually not a sale, but it's a financial arrangement and the asset is used as a collateral facility. However, if the performance obligation is satisfied as per IFRS 15, revenue from contract with customers, and then there is that means there is a transfer of risks and reward on the assets, then in that case, it is a sale. Then in that case, it is a sale. So the question we then ask ourselves is, how do we go about all of these and how do we account for it? If it is a financial arrangement, meaning it is not a sale, so what will happen is that the entity will just recognize a financial liability, that is the owner of the assets will recognize a financial liability as per IFRS 15 and continue to depreciate its assets in its own books. Then the purposed buyer or the lessor will also recognize a financial asset as per IFRS 9. Sorry. So this guy will recognize financial liability. This guy will recognize a financial asset. as per IFRS 9. Why? Because there has not been transfer of risks and rewards. But where the performance obligation is satisfied, then it is a sale. In that case, the owner of the asset has to de-recognize the assets, and the buyer of the asset, who is now the lessor, would have to recognize the assets. Then now the buyer, but then even though they have sold the assets, they leased back a portion of the assets. So it is not the entire asset that has been sold. It's not the entire asset that has been sold. So the principle that applied here is, and this is actually a slide from Open Tuition or Open Tuition in that case, that I want to just share with you on my screen. So if the transfer is not a sale, the following rules apply. Let's see. Let me bring it up into my workflow here. Yeah, that's better, so that I can annotate on it. So if it is not a sale, meaning it is a financial arrangement, for that reason, the seller continues to recognize his assets. The buyer does not recognize any asset. Why? Because it is not a sale. Then the seller recognizes a financial liability, like I mentioned, as per IFRS 9. And then the buyer, because it's a financial arrangement, I'm giving you the money, I recognize a financial asset. This is if it is not a sale, but instead it is a financial arrangement. It is not a sale, but a financial arrangement. But if it is a sale, meaning that, hey, we actually sold the asset, but then we leased it back. We actually sold the asset, but then we leased it back. So if we sold the assets, that means we de-recognize the assets. Then we recognize the sale at the fair value because we've sold it, we received the money, boom. The buyer, who becomes the lessor, will recognize the purchases of the assets. Why? Because there has been transfer of risks and rewards. Then we recognize present value of the minimum lease payment using Lessee Accounting as per IFRS 16. Then recognize rights of use as a proportion of the previously carrying value of the asset. Now, this is very critical. This workings here is a bit technical. And like I said, I don't want to spend a lot of time on IFRS 16. So I will not solve any question with you for now on the sale and lease back. Maybe later on, if we are doing our revision and we are looking at questions, then I could touch on this for you. But that's recognizing the right of use as a proportion of the previous carrying value of the underlying assets is critical, and it's quite technical, and I'm going to be illustrating that to you. Then any gain or loss on the rights transferred to the buyer is recognized. Why do I say that? Because yes, you sold the assets. However, you've also leased back the asset, which means there is a portion of the asset that you have retained. So that portion of the asset that you have retained is what you recognize as right of use. Then the portion of the asset that you have actually transferred, the carrying amount of that, and then the fair value of that is what gives you the gain or loss, which is recognized in the P&L account. Then the lessor, who is the buyer, applies lessor accounting and account for the transaction as per IFRS 15 and IFRS 16 in that case. So that is the concept of sale and leaseback. So in the question, we need to establish, is it a sale, and know how to do the treatment? And if it is not a sale, we need to also know how to do the treatment. That is what you need to understand when we talk about sale and lease back. Any questions for me real quick? Any questions for me real quick? So that is the idea about IFRS 16 leases, a three-part series on this, and try to touch on a number of things. What you need to do now is to make sure that you solve a lot of questions. Like I tell you all the time, make sure that you get an ICA question bank or a question kit. It has a lot of questions in there. You can solve and go through it. This is for corporate reporting, but if you are doing financial reporting, make sure you get it as well. Now, for those of you who are learning directly under my mentorship, enroll in our full course, you get access to our question kit, which also has a lot of questions in it that will help you to be able to study for the exams and, most importantly, pass the exam. So if you have any questions, you put it in the chat for me. I'm going to be concluding here around today, and God willing, tomorrow we will continue with another standard. Remember to follow me on Instagram, because the meeting or the discussion will be posted on my Instagram page, and you will get a notification about it. Then you can join the stream and look at it in that case. But tomorrow we're going to be looking at yet another interesting standard that will help you in order for you to pass the examination. Remember, like I say all the time, if you're writing financial reporting and corporate reporting, then you don't want to joke with the international financial reporting standards or the accounting standards, because your pass actually depends on the standards in the exam hall, and that is what you need to understand. So thank you very much for joining the stream. It's always a pleasure coming your way. I'll come your way same time tomorrow at 1700 GMT or 5 p.m. And we will continue with our discussion towards the ICA November 2021 examination. Remember that you can learn directly under my mentorship at 390 Ghana cedis per paper. We are starting with our live sessions from 5th of July 2021, where we'll be going through everything, getting access to our lecture videos, our ebooks, our question kits, joining our live session, joining our extra classes, which will happen on weekends, joining our dawn sessions, which will happen also later on during our revision session. Then you will join our executive revision masterclass and get access to our examination analysis documents, which provide you with the key areas that you need to focus on in order for you to increase your chances of passing the examination. So thank you very much. If you have any questions, 050-114-1996. You can see the number scrolling below the screen, and you can call or WhatsApp us, and we can assist you in order for you to prepare for your examination. Till we meet again, same time tomorrow, stay safe and stay blessed. Bye-bye.